to shift to a trailing stop loss once the first initial move is done, not right away. Stop loss, your friend in trading. Now, moment you hear the word stop loss, the first thing which pops in your head is loss. And loss booking is an emotional decision which keeps hurting you. The logic is you will suffer a lot more emotional pain with a loss of 10% compared to the emotional happiness of a 10% gain. So this is where it's a problem for a lot of people to actually get used to the process of cutting losses using stop losses. Now, what is essentially a stop loss? The stop loss essentially means to limit your losses at a predetermined point. Now, when you do that, you are limiting your risk, and that is very, very important in trading. Now, why is it important? Because the fact is, if you are a trader, you know you're not going to be right 100%. You're going to be right 30, 40, 50, 60, 70, 80% at max. So how do you limit when you lose money? The problem is, when you do not keep a stop loss, a single bad trade can take away a lot of your gains which were made in other stocks or index trades. So a stop loss limits your losses. Although it confirms your losses, but it saves you from losses. The second part is, when you use a stop loss, it also saves you from an opportunity cost. Because if your logic of trade is over, you did not be invested or have the trade open. So it stops you from losing further money. Second, it also limits your opportunity cost because the same amount of money can be deployed somewhere else which could actually gain. Now, the problem is a lot of people cannot do this because loss, as I said, is an emotional problem. So essentially, if you have a predetermined exit rule when you trade, you'll be able to do it. So I generally suggest your stop losses should be either in the system or in your brains as soon as you take the trade or even before it. Now, ways to decide a stop loss. Now, like I said, stop loss is your trading discipline. And if you have to succeed in markets as a trader, you have to be disciplined. Without discipline, all your strategies have no value because you end up making 10% in 10 stocks and you have a leveraged position and you lose 50% of all your gains. A single trade cut off 5 of your other trades. So trading discipline is important. Stop losses are important. So how do you decide a stop loss? Now, there are multiple ways people put a stop loss. Let us look at it one by one. The first one is a percentage based stop loss, which is basically a 5% stop loss, 8% stop loss. So if you pull up a book of William O'Neill, which talks about canceling trading strategy, they generally have an 8% stop loss on any trade. Now, if you're a short to medium term trader, you cannot have a 40% stop loss, right? So this is where a little bit of common sense, a little bit of stock volatility comes into play. But a percentage based stop loss is one way to look at it. The second way is to look at it in terms of supports or resistances, right? So if you're playing a bounce back trade, right, the support level, if it breaks, that's your stop loss. You're selling a stock on a reversal from the upper resistance. The resistance point, and I'll say a little bit of a margin above that, is your stop loss. So it is based on price zones, which is your stop loss. The third is the moving average based stop loss. Now, this is a stop loss which is based on various moving averages. So somebody could use a 10-day moving average stop loss. Somebody could be using a 50-day moving average stop loss. Why do I personally like moving average stop losses is because moving averages tend to signify the volatility of the stock at that point of time. So it is a characteristic of the stock at that point of time. So if you're taking a 20-day moving average stop loss, it has a look back period of previous 20 days, right? Now, stocks have different volatile periods. A stock, when in a previous bull market, would be moving up really fast and now it is moving really slow. The volatility is lower. Moving averages will adjust accordingly. So moving average stop loss is one of my favorite way of putting a stop loss. Now, the last one and a very important one which people do not look at in terms of a stop loss is a time-based stop loss. Consider you've taken a trade with a view of 2 to 4 weeks or a month. Why should you be in that position for the next 3 months? Unless and until the stock is doing much better than what you were expecting. So you'd stay in a trade, you can increase your holding period if you're in the money, you're making money on the stock or the index and the trend is going up. But if the stock has been doing nothing for the next 1 month, you want to get out because there could be other opportunities. So a time-based stop loss is also a gauge of opportunity cost of staying in a single position for a period of time beyond which you initially thought of. So the only time I would increase my holding period is when I'm in the money and the stock is doing much better. Factors to consider when setting a stop loss. The first one is market volatility. Now, there are different phases of the markets. There are times when the markets are very volatile. There are times when the markets are in a range. So accordingly, you need to set up a stop loss. And there could be different set of stocks. You cannot have a 3% stop loss in ITC and a 3% stop loss on Suzlon, right? One stock is relatively low volatile. One stock has a single tick, which is 0.5%, right? So you have a stop loss according to the market volatility and the stock volatility. The second is trading time frame. Now, if you're holding a stock for a short period of time, you say if you're holding a stock for a 1 week period, you cannot have a 20% stop loss and a 20% target, right? But if you're holding a stock for 3 years, you can have a 20% stop loss. So depending on your time frame, your stop losses can be small to large and deeper ones. Now, the third part is risk tolerance. Now, how much of a risk can you accept, right? That also accordingly will make you decide what sort of positions, what sort of style you want to go with. Now, somebody who does not have a large tolerance of risk may have a smaller stop loss. We will focus on low beta stocks relatively. So your risk tolerance will also allow you to decide the stop loss as well as which style you should be taking. The last one is position sizing. Now, this is where a stop loss is very logical in terms of what is your position size and the stop loss. See, theoretically, you can have a stock with a 5% stop loss. Now, consider you bought a stock at 100 rupees. The stock closes at 96. Your stop loss is not hit. The next day, the stock can open 10% lower. So your theoretical stop loss was 5%, but it could eventually become a 15% stop loss by the time you trigger it. So your position sizing is also very important. Just because you have a small stop loss does not imply you increase your position size by a big way, because a theoretical stop loss could be very different from an actual market stop loss. So now a lot of people have an overall stop loss also on the position size, which is the whole trading book. You're not going to lose more than 15%. The moment you lose that, you start cutting your size. So you can have a stop loss on a trade as well as stop loss on the whole book. One topic which is a lot of discussion generally around traders is stop loss hunting. What it essentially means is, on a shorter term time frame, at times there are few downticks very quickly. So for example, you have a breakout at 100, and if you're keeping a 1% stop loss, there is going to be a volatility of 2% for a normal stock. Now, many a times a stop loss hunting is generally a terminology wherein the stock breaks out, then pauses a bit, takes a little bit of a dip, and a lot of people get thrown out of the system. So very small stop losses would imply your stop losses will get hunted, because after a breakout, it's not necessary the stock will move right away. There will be a period of time, there could be few days till the time the stock does not do any movements. So you may have a stock bought at 100, it goes to 105, it could go to 98, but a lot of people get hunted in this move. So a stop loss hunting moves are much more frequent in intraday time frames wherein there are a lot of volatility. But generally, on a bigger time frame, there are lesser and lesser stop loss hunting moves wherein there are freak moves. So, but in the end, do remember, the market does not know your stop loss, right? So please do not blame the market for getting a stop loss. Now, let us look at some example of stop losses getting triggered and why you should be using stop losses. So let's take an example. In this case, it's a stock for Heritage Foods. The stock has given a breakout. You may at times call it, okay, the volumes were lower, etc. But consider this, if you had a percentage based stop loss, you would get hit somewhere in the middle. If you had a moving average based stop loss, you would have got hit in somewhere. But the maximum a short-term trader can have a stop loss is the major swing low over the last 1 month, 2 months, 3 months. So in this case, at this point of time, at least you should get stopped out, which is where the last major bottom is or the previous bottom. But if you're still holding the stock after this, now that's your mistake, because you did not exit on your predetermined strategy. So what is a failed breakout? A failed breakout where you did not trigger your stop losses is what hurts people. Losing 5% on a trade is not something which you get worried about. The point is, you liked a stock, you bought a stock, you did not keep a stop loss, the stock fell 25%, 30%, and you did not execute. That is a failed breakout, which is your failure, not necessarily market's failure. It's your discipline failure. Now, let us look at another example in front of you. Now, this is a chart for ABFRL. The stock was trending up nicely, gave a breakout, did a retest, again moved up, again made a fresh breakout into new highs, but did not continue after that. What happens after that? The stock starts falling. So maybe you bought it initially at 320, somebody bought it at 350 on the next breakout. The stock starts breaking down over the next 3-4 sessions. Now, the last swing low is at 320. If you do not trigger it there. Now, if you keep holding on to this position till the time it goes to 200, whose mistake is it? Is it a failed breakout mistake or is it your discipline mistake? Now, the reason we keep this stop losses is not all the times a failed breakout or a wrong trade will go down in such a sharp manner. But the stop loss is to limit your losses at one point so that you don't lose a huge amount of money going forward. Now, consider an example. You did not put a stop loss in a company like Diwan Housing Finance. You could lose 60-80% of capital, right? And no capital equal to no capital markets. So you need to conserve your capital, and that is where stop losses help you. Now, the next part is, what is a trailing stop loss? Now, trailing stop loss is where you've initiated a trade at 100, the stock has already moved up to 115, 120, and now the momentum is still very strong. You want to trail this position, you want to ride the trend. Even though you're a short-term trader, you had a view of, say, for the next 2 weeks, but the momentum was much faster. In this case, you can use a trailing stop loss, wherein even though you wanted to get out of the position, you book partial profits also, or you want to ride on to this position because it has worked the way you wanted to. So let us take an example. It is well understood by examples. So this is a chart for Bharat Wire. The stock gives a nice breakout, trendline breakout, large volumes, and does a sharp move in the first 3-4 days itself. Now, when you get such a sharp move, you don't want to be getting out of this trade. You want to ride it on. So what do? You shift your stop losses to a moving average. Now, consider a very simple example. You have a 1-month view. So you take a 1-month moving average or a little lower than that. So that would imply a 20-day moving average. So in this case, you've taken a 20 DMA stop loss. And now, till the time the stock is about 20 DMA, you'll continue to hold. So in this case, you bought at 115. You saw a quick move to 140. Now, because you kept a trailing stop loss, the stock has gone to 170. But your trailing stop loss has now moved to 155. So even if you get stopped out on the trailing stop loss, you've added another 10% more return to the same trade. So ideally, I would like to shift to a trailing stop loss once the first initial move is done, not right away. Now, take an example out here. This is a stock for PFC. The stock breaks out around 115, 120, a major range breakout. The stock quickly makes a move to 135, 130, 35 in the next 4, 5, 6 sessions. Then what do? You shift it to the 20 DMA. The stock goes to 145, 148. Then you get stopped out at 135. Now in this case, you might have got trailing stop losses just at the same price where you might have wanted to exit. But there is an opportunity the stock could continue in this trend. At times, if you get lucky, a stock can just continue without taking out your 20 DMA. So a trailing stop loss is an opposite of a stop loss, which is where you're extending the upside luck, right? You're not limiting the upside. In the same way, a stop loss is limiting your downside. Now, the trailing stop loss can be in another way. We looked at a moving average stop loss, which is where the momentum has taken up in a big way. But when you're trying to play, say, a little longer term time frame, a much bigger chart, and in this case, you need to keep a deeper stop loss, because if it's a 3-year breakout, a 2-year breakout, a 1-year breakout, you want to hold that for next 3 months. So in this case, you can have a deeper stop loss in terms of the last swing low. So you keep on a simple Dow theory stop loss, which is where every time the stock makes a higher bottom, that becomes your stop loss. So if you look at in this case, the stock went up from 75, 80 to 100, did a retest, again went up, did not break the previous lows, and has been trending slowly and steadily upwards. Now look at this. If you had a deep stop loss in this case where you saw a major trend change, the stock has gone up from 80 to 120. It's a 50% move. But you would have got stopped out when you kept a trailing stop loss very quickly, or you had a short-term time frame. So you can also use a mix of what you call as a deep stop loss, which is a swing low based, plus you start shifting to a moving average stop loss when a huge move has already happened. So now when the stock has made a nice move from 100 to 125, you want to limit that, you don't want to lose a lot of profits. You can now shift it to a moving average stop loss. But generally, when you start a trade, a fixed stop loss should be in place, whether it is moving average or swing low based. Now, take another example. When you are getting into a new long-term uptrend for a stock, right? How does it become a huge trade for you, right? You want to make a lot of returns. Like I said, it cannot happen in a stock cannot go from 60 to 200 in 3 days, right? So in this case, having a deeper stop loss, playing the larger trend can allow you to gain significantly. Now, this is a stock for Usha Martin, huge volumes at 40-60. The stock kept on making higher tops and higher bottoms. All through this, it did not break the last 3 months, 6 month lows, and it has still continued in a trend. And also, even in this situation, if you have such a deeper stop loss, you can actually be adding fresh positions with a fresh stop loss. So in this way, you can play a larger trend also. So stop losses can be defined in terms of what sort of a trend you expect as well. Now, a classical example of stop loss hunting right now is where this is something which can happen to you. Now, this is a stock called ABB. The trend has been good for the whole sector. The stock broke out about 34.50. There was some negative report by a brokerage outfit. The stock fell over the next 3 sessions. And your last swing low, which was the extreme short-term swing low, got taken out and the stock again went back. Now, this is something which hurts, right? You buy a stock at 34.50, you get stopped out at 3,300, and then the stock goes to 3,700. But that is a compromise you have to make when trading. Not all your ideas will work. At times you get stopped out and then the stock can make a move. So you might get hunted out, but that is something which you have to sacrifice for the discipline, because there could be another time when you did not keep this stop loss and March 2020 happens and the stock falls 30% over the next 4 sessions, right? So that's the reason you keep stop losses, and you will have to accept such situations where you'll get stopped out and the stock still does well. To sum it up in stop losses are your friend that tells you get out when something is wrong. And it limits you in terms of how much you can lose. It keeps you into the game, because if you do not lose a large part of capital, you can always make more money with the existing capital. But if you lose 30, 40, 60% of your capital by not keeping stop losses, it throws you out of the game. You can have stop losses in various ways: percentage based, market volatility based. A moving average stop loss is a good enough stop loss system to start with. And if you're looking at longer term time frames, you can use simple Dow theory principles, the major swing lows being broken. So to sum it up, keep your stop losses, keep your discipline if you want to prosper as a trader.